Welcome to Lickin' on Lending, the podcast that dives deep into the heart of the mortgage industry. Your host, David Lickin, bringing you the latest insights, trends, and updates from the world of mortgages. Whether you're a seasoned industry veteran or just getting started, this show is your go-to source for all things mortgage. On Lickin' on Lending, we're not just about delivering information, we're about delivering it in a way that's lively, engaging, and yes, even entertaining. You'll hear from a wide range of regular contributors, experts who make the complexities of the mortgage business not just understandable, but enjoyable. Our goal? To keep you informed on the operational aspects of the industry. Everything from regulations and compliance to technology and market trends, without ever being boring. We believe that staying up to date doesn't have to be dull, and our interactive conversational style ensures you'll be hooked from the get-go. So get ready for detailed discussions, lively debates, and a wealth of knowledge that will help you navigate the ever-changing landscape of the mortgage industry. Let's get started. This is Lickin' on Lending. Now your host, David Lickin.
Listeners, I'm always honored when I get to talk to someone like our guest, Mark Fleming. He is the Senior Vice President of Decision Scientist, which I want to get into, and also the Chief Economist for First American Financial Corp, a leading provider, which is, of course, we all know who First American is, leading provider of title insurance and settlement services, et cetera, et cetera. But Mark is just one of these people that when I talk to economists, sometimes you don't understand everything they say. You're not sure where they're coming from. There's sometimes a little arrogance. What I love about Mark is there's no ego, arrogance. There's just a real human being sharing facts with guys like me who doesn't always understand everything in economic theory and goes behind it or economic rules. But he breaks it down, and I'm so excited to have him joining us. Mark, I want to say thank you so much for taking time to be here to share your thoughts about all that is going on. And man, do we have a lot going on.
My pleasure. Good to see you in the new year, David. I got to say, I think the reason I break things down, that's how I got through graduate school. It's the only way to figure my way through all that economics.
That's a great place to start. How did you get to where you're at? And I say that for all the new industry participants that are listening to our podcast. A lot of people say, how did he do that? That sounds like something I'd like to do. So what's your journey to where you're at?
I think a little bit of luck and happenstance. I don't think when I was in college, I was like, I want to work in housing finance. That wasn't exactly my first choice. But when I got to graduate school, I knew that I liked economics. So I went to graduate school to study economics, and I got into a lot of modeling and started working with land use and real estate data. And basically the research assistantship and the dissertation started focusing on those kinds of things. So learning about housing policy, and then at Fannie Mae, housing finance and housing finance policy, it just sucked me in. I think for most of us in the industry, once you get in, you realize what a good one it is, and so you stay.
It is. It's such an important part of human actions. Getting someone into a home is the most basic need, meets one of the Maslow's law of hierarchical needs, of shelter. And we're providing that. And so it's a real feel-good thing when we do it and do it. There's a lot of stress in the industry. And we're experiencing a lot of stress right now, what's going on out there. What I'd like to get is your thoughts about the new Trump administration, especially when it comes to the cabinet picks related to finance. Are you excited, nervous, happy, sad?
I guess I'm always excited for a change because you just don't know what's going to happen next. I think that sometimes the known quantity, you get used to it. So change is always good, even though sometimes it can be a little bit disconcerting. I think when it comes to us, obviously the real big one or the big issue that's affecting us this year with the change of administration is the fact that there's now going to be a bigger push, we believe, by the FHFA to bring the GSEs out of conservatorship. And so that's probably the biggest and will likely be the most consuming or probably all consuming amongst many. David, you and I have been around long enough. I do recall like we've been trying to bring them out of conservatorship ever since we put them in over a decade ago.
They're back to where they started. Most of them started inside of the government, and then we spun them out. And so if you look at the history, so what are your thoughts on that? Do you see the pros and cons? Is it like a pro-con list on them in and out? I like change. I don't want to see it change because we've got such a healthy ecosystem right now. And I get nervous about them changing. They were outside in a quasi status with a good federal backstop. But what's your thoughts on them in or out, either way?
As you said, going back to the Great Depression, when we founded what became Fannie Mae and then ultimately following along with Freddie Mac and FHFA as well, or FHA, sorry, as well. They all started inside. They were taken out. Some were brought back in. We can take them out again. And throughout all of the whether in, whether out, they've managed to basically maintain the plumbing. And that's the most important part, is the plumbing in the housing finance liquidity and risk transfer process. So we can debate the finer points of what's necessary to make viable non-conservatorship organizations and how much capital they need to have and all those good things. But I think we just passed the 25-year mark for year 2000.
Yeah.
Remember that? January 1st. We thought the world was potentially going to end because no computer clock would understand how to tick
That's
over.
right. Yeah. Here we are.
It was fine.
Yeah.
It was fine. I think the liquidity and then the plumbing that the conservatorship organizations, the GSEs, provide, the day that the clock ticks over, it'll still be there.
It'll still be there, yeah. I think there's gets to be a lot of angst around some of this because it's the fear of the unknowing, and especially this administration coming in. There's been so many bold statements made and certainly been a massive resistance to it happening, but it is happening. And the next thing on the list is the Federal Reserve. Trump's made some pretty strong statements about the Federal Reserve. He'd like to do away with it. That would take an act of Congress, literally, for that to happen. I don't know if that's going to happen. But you listen to Chairman Powell talk about things, and there seems to be a little bit of an obstinance about Powell, and which maybe he's just asserting with a strong president's coming in, that this is going to remain fiercely independent of this administration. And I like that. I think that's a healthy thing. So I respect what Powell's saying. But the Federal Reserve's decision to cut or not cut, or to cut now, never, later, whatever. What are your thoughts on this? They're in a debacle.
They are in a bit of a pickle. We were all expecting that there would be more cuts this year. As of their September projections, they were suggesting a full percentage point more this year. And now even as of December, they'd already pulled that back to only 2. And the markets, if you believe the financial markets, they're thinking 1 or possibly no additional cuts this year. So it's going to be hard to tell. I'm not so sure. It's like Groundhog Day. We were talking about the Fed and cutting rates and not cutting rates last year.
Year ago. It does feel like, a redo.
But at the end of last year, when they were cutting rates, mortgage rates really had nothing to do with it. And Treasury yields went and did their own thing. And so I'm not so sure that it matters so much as it did before, as we thought it did, that the mortgage rates and 10-year Treasuries, which the mortgage is generally tied to, will do their own thing, regardless of, unless the Fed really does something surprising, which is highly unlikely. And our forecasts right now are that by the end of this year, the 30-year fixed rate mortgage will be about 6.4%. So that's not that much lower, honestly, than 7% handle that we're roughly around right now. So essentially, I'm saying rates are going to be around here for this year. And the truth is, again, David, you and I are a little older than some, maybe. Hey, that's normal. This is normal.
I know. You know, I've been through so many of the cycles where I remember doing loans at 18, 20% back when Volcker responded to the problems that we were having back then. And the Fed will do what the Fed does, but it does look like we're going to be staying here. Then it gets into really looking at the overall housing industry. And what does this mean for mortgage rates? Let's start there, and then I want to get into the housing part of it.
As we said, the mortgage rate will likely wobble around where it is, maybe drift modestly.
Do you have a range? I mean, do you have any idea of a range? That I guess that's where I've been trying to go with my question.
My professor in graduate school said, give a number or give a time, but never give both. And so it's, if I box myself in, then
we're going to be in this.
The range is probably big. So we could go up or down a half percentage point around that 6.4 mark. We may still end up at 7. We may get a lower to 6. Wouldn't it be great if we actually got below 6%, even if only fleetingly at some point this year? But I think we're range bound and somewhere in that 6. The first digit on the mortgage is likely to be a 6 for most of this year.
Yep. I agree with you 100%. So, Mark, when you look at rates getting close to a quarter of their all-time recent high back in 2008, are we at a peak? And is there any reason, or what are the factors that are going to drive rates lower? They say they're getting less data dependent and more looking at the bigger picture. Any insights you can provide us based on the Fed speak you're hearing?
Yeah, you had to bring up 2008. I shudder because remember, 2008 was really when the bubble popped, right?
That's exactly right.
And,
Yep.
and to your point, mortgage rates are now around the same level they were at that point. And the fact that mortgage rates had gone up modestly because the Fed was actually beginning to do a little bit of tightening at that point is really what caused the bubble to pop. Remember those 228 and
That's right.
327 loans, which they always worked if you could refinance into a same or lower rate, but then all of a sudden that wasn't
Couldn't.
there.
Yeah.
Now, I'm not suggesting that the same thing happens again. We don't have 327s and 228s.
No.
Everybody's got 30-year fixed rate mortgages. It's a much different world.
It is.
And we're not going to have this sort of financial crisis crash that just because rates are this high. But I think it goes and speaks to the fact that really since that point, rates have been abnormally low by any historic standard, right? We cut rates pretty dramatically in the global financial crisis, in large part to stabilize the housing finance system. That was needed. But then we kept them low for more than a decade. And so finally now we're getting them back up off that low point. And I think that's really what's causing the dislocation in our industry this time around is the getting back to normal is actually a little bit painful.
Right. Yeah, it is. It has been now that we had COVID thrown in there. But now we have some real interesting dynamics going out in California with the fires out just south of you. Well, you're not in you're not in California, are you? You're on the East Coast.
Luckily, I'm in Washington, D.C., but obviously my company's based there. I have a lot of colleagues in L.A., so it's definitely
a lot of them are being impacted by this. When you look at the fires, I look at the possible repercussions, the domino effect with insurance companies possibly failing with the massive losses that are out there. When you look at so many loans that have been sold on a scheduled servicing basis, and you look at how many companies can afford to continue to make advances in securities when it's so exorbitant. Any thoughts on that right now, the current drama that's playing out?
This is quite shocking, right? I think the latest estimate is over 10,000 housing units have been destroyed by the fires, and they're not over. So
we're still seeing more.
Yes, it is a big deal. It's interesting because these are homes that don't exist anymore. They're not providing the shelter, yet the people are technically still responsible to make the mortgage payments. Yeah. And we do know from past experience in major natural disasters that significantly impact the housing stock. Essentially, if you're an economist, you look at this very dryly as a supply shock and a demand shock, because essentially you are removing a chunk of supply of stock of housing and dislocating those individuals, many of whom will need to find some other form of shelter when there's less stock of shelter out there. So it creates dislocation on both sides. And we find that it generally increases demand for rental properties. And of course, because many of those rental properties were also damaged, that's also a now even shorter supplied stock of housing. It significantly drives up rents over the following year to 2 years.
Yeah, there's been a concern about recession. What's going on, California and the new administration? Is there any chances of a recession? They always said what takes us out of a bad place is a war. This kind of feels like a war. You look at the net effect, it looks like a war took place over there in parts of California. Is this going to actually help us avoid a recession? Your thoughts?
I don't think there was going to be a recession in the first place.
Okay, good.
But while it is devastating and it is a lot of homes, and the U.S. economy is very big.
Yeah,
very big. On the scale of the U.S. economy, this is not a significant component, even though obviously this is, I don't want to minimize the feeling and pain and the dislocation that's happening to people. But 10,000 homes, big deal in L.A.
Well, it's the dollar amount, I think, when you look at the size of it, and I get the triple effect of, could this cause for some insurance companies to fail? And that could have a rippling effect. I don't want to over dramatize this thing and make it worse, but I do get concerned about systemic problems coming as a result of this on a domino effect.
I think what's much more likely than actual insurers going under is insurers repricing or being unwilling to provide insurance the next go round. Yeah.
We've already seen a number of insurance companies pull out. State Farm, which has been my insurer for many years. Let's talk a little about housing supply. This is an area that you're an expert in all aspects of this, mortgage rates and what's happening, but your specialty is really in housing. I'm really interested in getting your thoughts about prices. We are dealing with a shortage of supply, even more so now in California with what's gone evaporated literally out of the market. But we've got a real housing supply issue. I'm looking at things. I'm investing in a company called Brix Modular, BRIX Modular, which is manufacturing really high-end quality homes. And we're seeing more new construction come on in different ways in a manufacturing way like this. What is your prognosis for our housing supply issue? Because that's the sticky problem, regardless of where interest rates are at. I don't care if interest rates fell to all-time lows, refinances, but is it really going to help the housing shortage? The shortage is a shortage.
Yeah. This to me is the single most important problem more than any other. And it was around before the pandemic. It was just around during the pandemic. It's still around now, and it's likely going to be around for a number of years to come, is that we have literally just not been building enough housing, multifamily or single family. And that can be even more exacerbated in parts of the country, like Southern California is even tighter than some other parts. But we've writ large not been building enough for at least a decade.
Right.
The estimates vary. Economists like to agree a lot with each other. Economists' estimates of the amount of shortage is anywhere from 1 million to upwards to 7 million homes. And to put that in context, there's over 100 million residential properties in the US. So you're talking about maybe 5 to at most 10%. But that's significant because it's in certain places much more so than others, right? There's actually excess housing in the Midwest, not enough housing.
It is regional. Yeah, it is a regional problem.
Yeah. But I know I looked at that and we've been trying to figure out where does this all go? And we're building about 1 million, at least 1 million single family, add to that multifamily, about 1.5 million housing units a year right now. Is that enough? Is that not enough? We went back and
it doesn't feel like it's enough, is it?
It's not close.
No, not even close. That's where you look at the demand.
Okay, so I'm an economist. I'm going to cheat a little bit here. I'm going to pull up my little slide that I had because I have to talk everybody through it. And we'll share it. David, I'll share it with you. You can put it out on your
Good. Yes, we will.
Media.
Absolutely.
So we went back and looked at housing starts over time since the 1920s. Okay. And we have to do one special thing to the numbers because we can't look at them in raw nominal terms because obviously the size of the U.S. economy, the size of the construction industry was very different in the 1920s. Right. A lot fewer people in the U.S. than today. So we're going to do it on a per 1,000 households to essentially control for the size of the economy and the population. In the 1920s, we were building about 10 new homes per 1,000 households. And then remember the 1920s, the roaring 20s.
Say that again. What's that number? We were building 10.
10.
Okay.
10 units per 1,000.
Wow.
In the 1920s, leading into the Great Depression, remember the 1920s, roaring 20s, we had a big expansion, industrialization. We got as high as almost 35. In just a short number of years, ramped up to building 35 per 1,000.
Wow.
Okay. Then the Great Depression hits, and obviously we stopped building. Then we returned a little bit, but then World War II hits, and we intentionally chose to build tanks instead of houses, right? In World War II. So we were battling around. We hit a low point right after World War II of only 5 per 1,000 households, 1945. But here's what's amazing. 2 things actually happened. And a little quiz, David. 2 things post-World War II that affect the housing industry. Any idea?
Baby boom.
Baby boomers, but what did the government do for all those soldiers coming
provided
back?
All the GI financing.
The GI Bill, which had preferential financing for giving them loans. And one other thing was the New Deal, we built the highway system.
That's right.
So all of a sudden you're building access out into all that farmland around all the cities and providing financing to people. And the home building industry exploded. In about under 10 years, it went from 5 per 1,000 to 45. And essentially, we ramped up and started to build the suburbs. I'm a big TV fan. Remember the TV show, The Wonder Years?
Oh, yes. Absolutely.
That was it. We have never built as many homes per 1,000 as we did in that era. It's basically been going down and down, not linearly since then. Right now, we are barely building between 10, 12.
And per 1,000. And then how does the growth of our population factor in that? That's just looking at, what is that a particular age group or is that just generally?
Housing stock built. So starts for a multifamily or single family. The thing is, by doing per 1,000, it might be sheerly more than in the 1920s.
But
that's
from a percentage
for
of the
1,000
population.
people, it's not
Yeah,
that much. And that's what
yeah.
matters, because you have to
So
build relative to the scale of demand.
so what is the solution to this? What can we do? Obviously, build more houses. Yeah, I get that. That's a pretty obvious thing. Add more supply, but the regulation is so burdensome across the country, especially when you look at California. They're talking about how long it takes and the cost. I think it was in San Diego. The cost that's built into every home is north of 50% to build a house. There's that much regulatory cost in there.
Yeah,
it is ludicrous.
The National Association of Home Builders, they break down all these costs, and they estimate that just in the last 6 years, since 2016 to 2021, that's the most recent survey they had, costs went up by 11%. To an average of $94,000 of regulatory costs. That's the nationwide average. And to your point, there are some places that are much higher. And I would argue that probably these regulatory cost burdens didn't exist in the 40s and 50s.
No. And yet you look at the quality of the construction back then, it was good quality.
I lived in a house not too long ago that was built in 1954, and it was still around, right? So they were built very well back then. And I think that belies they had access to land. They had lots of nearby land. They didn't have regulatory cost burdens. These are all the things that make the 1940s and 50s different from today. That's not to say that we can't do it again. Realistically, regulatory burdens, that's a burden of our own proverbial doing, right? We can undo regulation just as we did regulation. If we wanted to. And that certainly would help. But you do still have the challenge of the land, because the large amounts of unbuilt land are that much further away from the urban cores today than they were back then.
What about the ADUs that they're looking at putting on properties? It's getting very popular in California, also here in Austin, Texas area. What about the ADUs?
David, you can tell your listeners, we did not plan this, but that's a perfect segue, right? So if you can't build further away, build more densely closer in. Exactly. Yeah. And so, yes, accessory dwelling units are a good example of how you might do that. The only problem is much bigger than a few ADUs, right?
All right.
It really does have to be that you turn low density residential housing, sort of your 1 acre, half acre, 2 acre, residentially zoned lots, and you have to upzone them to significantly higher densities. That does two things. One, obviously, it provides more housing close in, but it also provides affordable housing. Remember, last time we talked, that's not an unforgotten problem, is the affordability issue.
Huge issue.
If you build slightly smaller homes and you share the regulatory costs on that lot and other things, you can essentially build more housing and more affordable housing.
Yes, I get excited about what that means. We're looking at smarter homes. We're looking at more efficient homes. And so there's some exciting things that are happening. But what about upgrading our current housing stock? We've got some housing that needs, like our freeways, like our infrastructure. There is a serious upgrade. What is the opportunity in that?
I just have to laugh. There's a great stat that just came out recently. I think it said the average age of the housing stock, the average age of all the housing out there is 39 or 38 years old. Their housing is in its late 30s now. And they were saying, and it's going up. I got to do a little math check here for our listeners. If we roughly replace about 1% of the housing stock every year, and we started building it largely in the 90s and 50s.
Right.
You see where this is going. If I'm only replacing 1% of it with new, the other 99% gets what? A year older. And oh, by the way, even economists can forecast age pretty well, right?
Yes.
So it's 99% of the housing stock gets 1 year older, 1% is new. Of course, the housing stock is getting older.
Yes.
But to your point, we should be actively seeking out the older, dilapidated, sort of dysfunctional stock and really focusing on renovating it, but most importantly, renovating it to a higher density than the one that it was before.
Right. And I think I remember when the NBA put out their statistics, would you like this? And there's a lot of controversy about the bill passed the House where we're increasing density in these communities. But like I own just about a little over 2 acres, and I'm realizing we don't have a density problem in the little community I live in, but it could be here. And all of a sudden there could be 4 homes on one I own as my private residence here. So it's very possible. I started looking at that and I go, sure, we could put a house here, probably 2 in the back. And increase. That's what happened to my house up in Washington State. There's now 6 houses on the 2.5 acres horse farm that I had up there. So I look at it, it is a trend that is already well underway. As far as building out, do we see anything happening with transportation that would cause us to say that we're going to be more effectively or efficiently and cost effectively building out further from city centers?
This is a challenge. Yes, you can keep going further out, and there is some interplay.
Some markets you can. There's some like Seattle, you get landlocked or waterlocked, mountain locked.
I love San Francisco as a perfect example.
Oh yeah, that's a really good example.
It's surrounded by water on three sides, right?
Yeah. Yep.
So there are challenges with, ultimately, I don't think you fix it by continuing to build out, because at some point it's too far away for the drive, right?
Exactly.
And
right.
I get it. Maybe we don't have to go into the office 5 days a week anymore, although even that is now beginning to change this year.
Yes.
Back to the 5-day work week. And the roads, if you build a road, what we've typically found is you widen the road, you build the road, it just gets congested again.
Yep.
Because you encourage the building, the people move out, and then there's all the
Which goes back to, we need to work and focus in on what housing stock, how we can make it denser, practically working with what the housing stock we have and going into increasing density.
Yeah, how can you make it denser? Or if you want to build further out, don't build a bigger road, build a public transportation.
Yes, that's exactly right. Yeah.
You know, but this is beginning to go against the American ethos, right? Like driving my car and all that, especially where you are in Texas. So I think there are societal, cultural challenges to some of the things that we might need to do to adequately supply reasonably priced housing with reasonable commutes to working locations that aren't necessarily how we've grown up and lived. And in large part, that has to do with, I love the little history lessons here, right? That lots of America was built and grew up in the car era.
I know it. That's exactly right.
So if you look at Europe, these cities in Europe that were built when the cost of transportation was really high, it took a long time for me to walk or ride a horse to the factory.
Yep.
And so everything was built more densely because transportation cost essentially was really high. We create the Model T, the ubiquity of the car and a cheap car and free roads to drive the car on with the interstate highway system. And all of a sudden you reduce those travel costs and this is what happens. Boom, we spread out.
Yeah,
we do that indefinitely. I don't know.
As we wrap this up, I want to get your predictions for 2025, both from, we've already talked where interest rates are. We're going to stay pretty much where they're at. We may have a pretty wide range in this year. That could be for certain. I agree with that. But when it comes to housing, what are we going to be? I don't see any quick solutions to the housing supply problem. Any thoughts?
No quick solutions. No quick solutions. No. Longer term solutions, really focusing on, I think, from the federal government's perspective, how do you incent local governments to change their regulatory and their behavior? Because these are decisions that get made at the local level, not the federal level. So maybe there are ways to create incentives for all of that. But in the short run, we're looking at an asset in short supply. So if you are a homeowner, that's actually pretty good for you. You got a 30-year fixed rate locked in mortgage and an asset that's in short supply. If you're a potential first-time home buyer, it's going to be hard. It's going to be hard for a number of years.
It's going to be difficult. Yeah, we're looking at property values right now. We're looking like in Austin, which is really interesting. I mean, that's the city we live in. But it's true of many other parts of the market. I work closely with Alan Weiss of Weiss Analytics, who used to be the co-founder with Case Shiller Weiss of the Case Shiller Report. And we're actually seeing property values in a good amount of Austin, the north section and the eastern section, and then down south again, all going down in value at this point. It's a temporary aberration in the market is what I predict, or what I'm thinking. I'm not an economist. I'd love to get your thoughts on that. Parts are closer in. It's also newer stock where we're seeing still heavy demand and good home price appreciation in a certain sector close to the center of the city and a little bit of west from the city, which happens to represent a lot of new construction. Very interesting, these dynamics, what's playing out. Going up in some parts, going down in others.
I'm reminded of the old adage, right? Real estate is, of course, local, and that applies not just to a metro versus another metro, but within metropolitan areas.
Within metros, yes.
And we've seen this happen before, that there's this concept in economics of the urban-rural fringe. Essentially, you could imagine a ring roughly around any city. It's not a perfect ring, but you could imagine it, where all the builders are basically converting agricultural land into low density residential, that's your fringe, right? And that's because essentially it's worth it. There's enough demand collectively pushing that fringe out that it converts that farm. The farmer gets paid more than it's worth for him to continue farming because the developer, sell more houses at a higher price.
Right.
But that fringe can shift back the other way, and you can be on the proverbial wrong side of it again. We saw that happen in many metropolitan areas in the global financial crisis.
Yeah.
And so you see price corrections happen when the fringe comes back the other way, and now there you are, you're a home builder, you built all these new homes, or maybe you're the first owner of a new home. It was built a few years ago, and you're now on the wrong side of the fringe because it's contracted, essentially.
Yeah.
And that has to do with the demographic in and out flows in markets over time. So housing is a pretty good investment. You usually don't lose value, but nothing in life is guaranteed.
I think the macro trend is definitely with the supply issues that you've outlined. And we have a growing economy and not much chance of a recession. So I think the current issues are going to be there. Income's got to go up, and we got to solve the affordability issue more than anything else while we're working on a long-term problem, and that is the supply issue. Mark, it is such a joy to have you on the podcast. I can't stop thinking about all our previous conversation. We're going to have you back a lot in 2025. And I really want to zero in on one of the areas that you're passionate about, and that is the housing. Bring you into some of the things that we're seeing developing, and anything you have that comes up, that your studies that you're doing, please bring it to our attention so we can amplify that, what you're talking about.
Sounds good. Excellent.
Thank you so much for being here.
Thank you, David.
Thank you.
You've been listening to Lykken on Lending. Our passion is to bring you the latest insights, trends, and updates from the world of mortgages. So on this show, if you're a seasoned industry veteran or just getting started, it's your go-to source for all things mortgage. We hope you've enjoyed the show. We'll be back soon. Take care, and we'll see you next time on Lykken on Lending.